Welcome to our presentation on the Nationwide Mortgage Licensing System and Registry, or NMLS. In this video, we will discuss your responsibilities as a licensed lender, proper procedures for detecting fraud in borrower applications, and regulations the bank must follow when advertising mortgage products. The NMLS was established thanks to the passage of the Safe Mortgage Licensing Act in 2008. This act requires a license for any person who takes or solicits loan applications or who negotiates terms. The act was designed to enhance consumer protection and reduce fraud by encouraging states to establish minimum standards for the licensing and registration of state-licensed mortgage loan originators. As an NMLS licensed lender, you are working for the borrower, but you also have an obligation to protect your bank while maintaining an ethical reputation. Under the Federal Trade Commission Safeguard Rule, as well as the Gramm-Leach-Bliley Act, which is also known as the Financial Services Modernization Act of 1999, a borrower's information must be kept confidential. According to the Fair Housing Act and the Equal Credit Opportunity Act, which established fair lending policies, everyone has the right to apply for a mortgage. When assessing a borrower's income, you must consider public assistance, but only if the assistance meets program requirements for income. You do not have the right to change documentation to assist the borrower in meeting program guidelines. Doing so may constitute mortgage fraud. You can be penalized or fired if you fraudulently alter any documents for the borrower. Redlining is refusing to take an application due to the location of the property. Redlining was made illegal by the Fair Housing Act due to a history of financial institutions preventing marginalized communities from accessing loans. Reverse redlining is stigmatizing an area because of risk factors or because of the area itself, resulting in charging more for the interest rate and fees associated with obtaining a mortgage. It also includes steering the borrower to live in a certain area or to take a specific loan program. This type of redlining is also against the law. Under the Real Estate Settlement and Procedure Act, or RESPA, no referrals or kickbacks can be paid for any reason. A kickback is defined as an illegal fee or rebate paid to someone to gain that person's decision or recommendation. A referral is anything of value being given or received from a third-party company, real estate agent, or builder. If an appraiser is connected to anyone on the loan, the appraiser must be replaced, as this is considered a conflict of interest. You cannot talk to or contact the appraiser to influence value, threaten payment, or cut them off from the prospect of a new business. Now it's time to discuss the common types of mortgage fraud you may encounter and how to identify them. The most common types of fraud encountered by lenders are asset fraud, income fraud, wire fraud, application fraud, employment fraud, and liability fraud. Asset fraud occurs when a loan applicant falsifies assets on their application. All income, assets, and any information used to qualify the borrower must be verified, and it is your responsibility to make sure the bank statements and income from borrowers are legitimate and match up with your verifications. Income fraud occurs when a loan applicant misstates their income for qualification purposes. Again, income verifications must match the documentation provided by the borrower. Verifications showing overtime and bonuses must also state the likelihood of continuing in the future. Wire fraud occurs when borrowers receive requests for funds to be wired to someone that is not connected to the transaction. It is vital you inform your borrower not to wire funds without asking you or the title company if the request is real. Application fraud involves any loan application containing false information about the borrower. The information on the credit report and application, such as the names, social security number, residency, and work history, must match the verification. The seller's name on the sales contract must match the name of the owners listed on the title report. A mismatch constitutes a major red flag. Employment fraud occurs when the applicants provide falsified work history. The applicant's bank statements and income deposits must match verification of the income. Liability fraud occurs when the borrower fails to disclose all debts, alimony, or child support payments. Power of attorney is a document used to appoint one person to make decisions on behalf of another person. Power of attorney must be approved by the chief lending officer before it is allowed, as fake POAs are a leading cause of fraud. It is your responsibility to report to your compliance officer any loan files that you suspect contain fraudulent information provided by the borrower. In an instance where fraudulent activity is suspected, a suspicious activity report, or SAR, may be filed by the bank. If the BSA department asks for more information to file a SAR, you may not disclose the filing to the borrower. Now let's discuss the bank's responsibilities related to advertising. The federal government is very strict regarding advertising practices for financial institutions. Here are some things you should know about how the bank advertises loan products. All rates, products, or programs are reviewed by our compliance officer to ensure that we are compliant with the Truth in Lending Act and the Unfair and Deceptive Acts and Practices laws. Fair lending laws make it illegal to use bait-and-switch tactics, such as using enticing rates to encourage a borrower to call and then trying to switch them to another product. Using any language, words, or information that is detrimental to the borrower, or language that indicates the borrower should not apply with our bank, may be in violation of fair lending laws. When advertising or discussing rates with borrowers, the bank must include the annual percentage rate, or APR. If any other numbers are mentioned, all Truth in Lending Act, or TILA, trigger terms must be disclosed. These include the amount or percentage of any down payment, the number of payments or period of repayment, the amount of any payment, the amount of any finance charge, or closing costs. Lenders should also disclose all costs and terms of the loan on the loan estimate. The loan estimate and closing disclosure must be delivered according to the required timeframes under the TILA-RESPA Integrated Disclosures, often abbreviated as TRID. Be sure to answer all complaints and phone calls from your borrower. According to the Consumer Financial Protection Bureau, one of the biggest reasons for complaints from the borrower is a lack of communication from their mortgage lending officer. Borrowers, co-borrowers, and co-signers are responsible for a loan if they are required to sign the mortgage. An informed borrower is the best type of borrower. Keep your borrower in the loop, as continued communication with them is critical. Thank you for watching our presentation on NMLS Guidelines, and have a great day.